Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go.
All right. Hey, what's going on, Dave?
Hey, Paul, we're back. Man, not much. I'm enjoying a nice quiet house right now. All the kids are not in the house, so makes it easy to record another episode with you.
Yeah, Tammy's downstairs with our kids playing the game of life.
Oh yeah, not Monopoly. Have they played Monopoly?
They play Monopoly. I think I need to get the game like Cash Flow for Kids or something eventually.
Yeah, I played that. The adult
That's supposed to
version.
be a good one.
Yeah. I think the kids version would be really good. I haven't done that, but I've heard only good things. So it's a great idea. It's just a matter of keeping the kids at a board game entertained for long enough for them to learn something, because they're so used to being stimulated visually and audibly and every other way that board games are difficult for them these days.
Yeah, folks might get a laugh if that door just cracked open and one of them just poked his head in here, but recording
Yeah.
at home.
Yep, that's the life. 2021.
Yeah.
All right, about to be 2022. Well, hey, why don't we, I'll recap a little bit of what we talked about last episode, and then we'll move into what we're going to talk about today. So on the last episode, which was episode 2, this is episode 3, we were just talking about infinite banking, what it is from a high level. And then, we talked about that you finance everything you buy. You either pay interest to an outside source to borrow money, or you lose the opportunity to earn interest on your own money when you pay cash, right? So it's kind of working on that paradigm shift of how people view money, and especially opportunity cost and paying cash for things, which seems to be a popular mantra from the financial entertainer sector. And we talked about some examples, how it's kind of like a mortgage and a HELOC, and talked about buying cars, financing cars through the policy. So if you didn't listen to the last episode, go back. It's a good one and sets you up for success with this episode as well. And this one we'll really be talking more about the solution. How are these policies created? Functionally, practically, how do you utilize them? So, maybe that's where we'll start. So we talked the problem. Now let's offer a solution, which is dividend paying, properly structured dividend paying whole life insurance. So Paul, why don't you just kind of go with, how these things are structured, how we create these in the first place, maybe.
Sure. Well, I think first and foremost, and again, I said this in the last episode, I'm going to repeat myself a lot because some things bear repeating. I think if coming into this fresh, knowing nothing about IBC, the first thing one needs to do is read the book, Becoming Your Own Banker. Maybe read how privatized banking really works. Maybe read the case for IBC. That is essential. Right. And I don't know about you, Dave, but that is generally when I'm getting with a new client. Before we get into the weeds, we're not doing any illustrations. We're not doing any of that stuff. They've got to read the book first. So I think that's like step 0 is read Becoming Your Own Banker several times.
Right. It's education.
And then, follow up, ask for.
Yeah, that's always the first step in my process. And every time I skip that step with a new prospect or client, it bites both of us in the rear at the end of the process, because they get cold feet because they don't really understand what they're getting into. And at that case, I don't want them to get into it because they didn't do the work on the front end of getting educated to understand why they would want to do it in the first place.
Yeah, it's a great point. So read Becoming Your Own Banker. It's going to take several reads. It's a short 92-page book, but there's a lot of golden nuggets in there. And if you really want to understand the essence of IBC, and understanding of infinite banking by reading that book is essential to moving forward. So that's the first step. The second step, I think, is you need to find someone that you can work with and that can work with you. And I think it should be an authorized infinite banking concepts practitioner from the Nelson Nash Institute. There's, at last count, Dave, is there 600 of us? Maybe 500? I don't know.
Yeah,
in the country?
Something like that. Not a lot.
There's not a lot. I snuck in just under the 500 mark, I believe. So there's not a lot of us, but you can look us up through infinitebanking.org on the practitioner finder. You can find someone in your area. You can find someone that's maybe was referred to you. You can read about us on that website and get to know who we are. Anyway, so that's like step 2. Find yourself an authorized infinite banking concepts practitioner. And then from there, the education, it never stops. You're going to do, I'd say this, as both a client first and then an agent. The more that your agent knows about you and your dreams, what you do for a living, what your income is, do you save money? What does your current investment portfolio look like? Are you a 401k IRA person? Are you all those things? What do you pay on homeowners insurance, car insurance, all these things go into being able to properly design, because all these policies that we design for our clients are all custom made. They're all custom made for that family or that individual. Okay. So that's important. And then once you kind of get to that point and, the education's there and your agent has kind of because I want my clients to be 100% comfortable and knowledgeable about what they're about to do, because it is atypical. What we teach people to do is outside the mainstream. And again, I think I said this on episode 1, like your Uncle Bob's going to be like, oh my gosh, that's a terrible idea, man. Don't do that. And you have to get over that, right? So I think, from there, once you understand the why, the how becomes easy. And do we want to talk about, we don't want to talk about policy design at this point, Dave, I don't think.
No, not policy design, maybe just a practical, what are the mechanics of it? From the flow of dollars from my pocket through the policy to then making an investment. But hey, let me say something real quick about, you keep saying the word agent. So I don't think we've explained this before. When Paul or I say agent, we are life insurance agents. We're licensed life insurance agents and really licensed in all 50 states if we have clients in all 50 states. But also, not every life insurance agent is a infinite banking concepts practitioner, right? But every authorized practitioner is an agent. I'm pretty sure that's correct. So when we say agent, we're talking life insurance agent, and ideally the practitioner who you're working with to help set up your specially designed policies. So that's all I got on that.
No, great. That's a great point. So we touched upon it in episode 2, how you get started. You're past the education process. Now you're ready to go and apply for life insurance. You've sat down with your practitioner, your agent, and you've designed a policy or series of policies for you and your family. Now it's time to pay a premium. And you have multiple choices on how you pay. We both have clients that pay monthly. We have clients that pay annually. There's no right or wrong way. It's whatever fits your personal situation, right? So you're gonna get your policy, go through underwriting. When I say underwriting, right? So life insurance, you have to qualify to get it.
Yep.
You have to be healthy enough to receive it. And there's different kind of health levels. I would say most people are standard ratings, which is just fine. People kind of get upset when they're not super preferred, or it doesn't matter.
Most people are average. That's just a fact of the matter, because that's what average means, is the majority of people. And yeah, you're right. The majority of people are standard. It's just the way it is.
That's the way it is. The whole point is to get through underwriting. The life insurance company is going to want to know about your income level to make sure that you cannot be overinsured, right? you can't take a $30,000 car and have $100,000 of insurance on it, right? That's not something and likewise for human beings, we only have so much what's called human life value in the life insurance industry. And that's based on a combination of either your net worth or your income. So generally, life insurance companies look at you as working until age 65. So if you're a 30-year-old man or woman, you can get, your income times probably 30 or 35 times your income in death benefit. So that's your kind of your human life value, right? It's your future earning potential.
Right.
So you get through all that, you get through the underwriting, you get approved. Your agent will issue the policy to you. We'll go through a review with you to make sure you understand everything, and you'll sign the contract. We deliver our policies generally. My clients are in different states, just like yours. Sometimes they'll be e-delivery if they're can be delivered in person because they're local clients. Of course, we deliver them in person. And then you begin paying premium, either monthly or annually. And that's when that equity, it builds immediately. 2 weeks after you pay your premium, sometimes less time, there's cash value showing up on your online portal that you can see and touch and access if you need to. And we'll probably do another episode on policy design. There's a way to capture lump sums of premium in the first year and other ways. Not necessary. A lot of people, that's one of the fallacies, Dave. A lot of people think you have to be, one, rich to do infinite banking, and two, pay a ton of premium. But I'll tell you this, everyone starts where they're at, right? Not everyone is going to be paying the premium that you or I pay maybe, or that some other person pays. You start where you're at. And that's why these are individually tailored. So,
and you'll get more comfortable with it as time passes, and ideally create a whole series of policies. I think Nelson, before he retired from this earth, had at one point in his life, it was something like 40 something policies, maybe. I don't know the exact number, but
yes,
that's a lot of policies, right? And we'll talk about how you can actually get that many policies. But yeah, like you said, and you're talking about paying premiums, another thing we like to say, you're capitalizing your bank, right? You're capitalizing your system. So that's, if you think about it like that, and that's just another paradigm shift that people who jump on board with this concept realize they're capitalizing something. They're not paying, it's not an expense to them. It's a capitalization. So different words.
Right. I guess this might be like a quick time to just talk about my personal experience, because we had similar backgrounds, but I was paying whole life premium for years, from 2003 to 2019, right? With vanilla whole life. But I viewed those premiums as a liability, right? Kind of a necessary expense. And now that I have properly structured whole life insurance, I look at, I've often said this, my infinite banking policies are my favorite asset that I have.
Yep.
By far, because I know what they're going to do. I know they're going to be there for me and my family. And that's, it's a nice place to be when opportunity arises as well. So.
Right. And we will get into the actual structural design of the policies in a later episode. But let's just compare the policies that we create and that Nelson advocates to use as a banking system versus the policy that you got all those years ago, a whole life policy, which I had one too. I think I started a typical just vanilla whole life policy in 2004. And had it for about 2 years until I decided, hey, I'm just going to get rid of this. It's stupid, and buy term and invest the difference. I bought term and I never invested the difference. And then I realized, hey, there's an actual better way to utilize these policies. So the way we design it is completely different than you've ever thought about life insurance. So a typical person, and this is where the whole paradigm shift comes in and flipping everything on its head. In the insurance world, we're usually trying to get the most insurance coverage for the least amount of premium, right? What we do is the exact opposite. We're trying to pay as much premium for the least amount of death benefit possible. And you'll understand why that's the case after you read a book or after you listen to a few more episodes of this podcast. But it's all about creating a banking system. And by structuring it that way, you're able to accelerate the cash value and start utilizing it for all of your lifestyle financing. So I'll let you take it from there, Paul.
No, that's a great point. The structure of IBC style policies is very important. Most whole life policies will not create any cash until about year 3. I know that was the case for my old ones, and of course that I was paying as little premium as I could for as much death benefit as I could get, so that there just wasn't any appreciable amount of cash I could utilize for anything.
Right.
You know what I mean? So I guess, where does the paradigm shift? I think that's an important, I'm going to speak on that for a sec. I think that's important because I think it, I read these books when you sent them to me out of the blue, and immediately took massive action. Not as massive as I should have, right? I hung on to that thrift savings plan for another year or so, but
right.
You were trying to convince me otherwise. Like, hey, why are you doing that? And I was like, well, I don't know. I didn't really have a good answer either. So where does the premium dollars come from, right? Where are you saving your money is the question you need to ask yourself. Are you, do you have savings? Like, where's your emergency fund? Where's the money you sock away every month for next year's vacation or whatever? So I think it's important to talk about, if you did nothing else but just changed where you put your savings, right, you're going to be in a far better position over the long term than you otherwise would have been. So I think that's important to understand. We don't need to create additional cash flows to pay premium. We can use current dollars that we're already saving. We just put them in a different asset class. So when we hear, Dave, compared to, people want to compare paying premium, building cash value and life insurance to their S&P 500 index fund or their 401k or their IRA. And that's not an apples to apples comparison, right? Like, we want to compare this to other safe, quote, safe liquid assets. Is that right?
Yeah. And the only one I can think of would be a savings account. That's really the way I view this, is that's all it is. It's a different place to save your money. Your money has to reside somewhere. So why not find the most efficient and beneficial place for your money to reside and the great part about this, it's while you're waiting to use it and while you're using it. So that's the big difference between this and a savings account too, is with a savings account, when you use your money for something, it's no longer in the savings account. It's gone being used for something else. If you save your money in one of these specially designed policies, when you access those liquid funds to use for whatever you want, investing or buying a car, putting a down payment on a house, you haven't used your money. Your money is still safely inside the account earning for you the whole time. You're just leveraging it. So, but yeah, comparing, because we always want to compare something to something else, especially in the financial world. So if you want to compare this to anything, it's a savings account. Paul and I will never, ever, ever say that life insurance is an investment. Anybody who says that, I recommend you turn around and walk away, because they don't understand the purpose of life insurance. What do you think, Paul?
Yeah, I think that's spot on, right? We want to compare. We would do fair comparisons. It doesn't mean that the cash value that I'm accumulating, the capital that I'm building inside my 6 policies, is not going to be invested. That's not what it means. It's being put there first before it goes and does whatever I want it to do, whether that was finance a car purchase, finance a passive income stream, and producing investment or something like that. So I think this is where it's important to talk about uninterrupted. We talk about compound interest, but I like John and John. They said uninterrupted compound interest is perhaps the 9th wonder of the world. I was listening to their podcast the other day, and I liked that. So people don't realize just because you leverage your cash value, you take a policy loan from the life insurance company, your cash value inside your policy is untouched. It is continuing to earn interest. And if there's a dividend declared, which there's a very good dividend history with these mutual life insurance companies, it is still earning all of that while it's doing something else for you as well on the side, whatever that thing is. So very, very powerful tool. And if you can understand that, you can definitely become your own banker.
Yeah, absolutely. And that's why we'll always say, when we talk about taking loans, we say we take a loan against our cash value. We'll never say, and if we do, it's a mistake and it's by accident. But a lot of people say, when you take a cash value loan or a loan from your cash value, they're using the improper terminology. Because I want you to picture in your minds two piles of money. On the right side, that pile of money is yours. It's got your name on it. And you have an equal pile, same size, on the left side. That's got the insurance company's name on it. Anytime you want to access any of that cash you've built up, you're going to go to the left side, the insurance company's pile of money, and borrow their money. Yours is going to stay untouched, earning uninterrupted compound growth. Just like Paul said, like, compound growth is a great thing, but how's that work in the stock market when you lose 30% one year? Right now you're compounding on 70% of what you had before. That's not great. So is that really compound growth? I mean, how about uninterrupted compound growth? The ninth wonder of the world. Never heard that before. That's good.
Yeah, that's why I stole it from them. So good on you, John. So yeah, it's so important to consider that and I think that's one of the fallacies. You'll hear that all the time is, I have to pay to borrow my own money with this infinite banking thing. And Uncle Bob told him that, unfortunately, like, hey, you have to pay to get your own money. Well, that's not true, right? We just explained it. So Dave, great descriptive, even on the video here. I was like daydreaming here, picturing it in my mind, the two piles of cash.
Yeah, I could have made it more using more adjectives, big sweaty wads of dripping wet cash. If you make things really crazy in your mind, you remember it. So make that picture as crazy as you want, because it'll stick with you. And that's what you need to remember, though. You're never taking your own cash, ever, unless you take a surrender, which we would never recommend you do.
I wanted to talk about that. So we're talking with infinite banking, right? We're talking about leveraging our money through the use of the policy loan feature that is part of your contract. Clients ask, hey, can I take withdrawals out someday if I want to? I say, yes, you can do that. But let's look at your guaranteed growth on your illustration here and just say, if you withdrew $100,000 out of this 20 years from now, you have now interrupted the compounding of the future by that amount of money. Why would you want to do that? And once you show them that kind of in what the policy is going to do, especially as your policy gets more efficient every day. Whole life insurance, dividend paying whole life insurance gets more efficient as it gets older. It'll be the most efficient on the day you graduate, right?
Yep.
So if that's true, which it is, don't interrupt your compounding. Use the policy loan feature. And Dave, you probably find this to be true, right? People hear policy loan and they think amortized mortgage, amortized car payment type loan. And we've kind of talked about how the policy loan works, where it's one, there's no repayment schedule, you pay back on your own, but it's a simple interest loan as well. So it functions, and this is for my real estate investing audience here, it functions more like an interest-only home equity line of credit, interest-only HELOC. Because when you make a payment, right, that's going to mostly principal. In some companies, right, they're calculating the interest every day, but it's actually charged in arrears on the anniversary of that policy loan. So that's kind of the mechanics, maybe a little too into the weeds, but all I'll say is this: the bottom line, it is a very favorable borrowing position to be in.
Yep. Yeah. And when you talk about, so here's what I would say, even if you were going to spend your own cash on something, it's important that you understand that that cash has value. Like people, it's called economic value add. It's a little more than something we want to get into on this episode, but it's the fact that your cash, your savings actually has value, and you should always treat your own money as if you were borrowing it from someone else and assign a value to it. So if you were going to take, I saved up all this money, I'm going to go put it towards this investment because I'm going to get 3% return on it. Well, okay, you could view that as all profit, but really how you should view that is that 3% is not good enough because my money actually has value and costs attached to using it. So I need to, by putting it over here in these life insurance contracts, it's made me, and maybe Paul, it's done the same for you. It's made me a much more savvy investor and a much more patient investor, because now I know I have to pay interest to borrow the insurance company's money to go do my investing. So now, there's nowhere I put my money where I get less than double-digit return on it, and a very, very secured return. I don't do stock market. I don't do speculative investing unless I'm completely okay with losing that money. But it's made me a much more savvy, much more patient investor. But what's funny is I don't have to be patient anymore because these opportunities come by so often that as soon as I have cash built up that I'm ready to deploy and put to use, there's an opportunity there waiting for it. So I don't know. Is that your experience too, Paul?
It's totally been my experience, especially, I started I switched my strategy from, retirement planning as far as an accumulation strategy to a cash flow strategy where I'm building cash flow now, just like you have been doing. And yeah, absolutely. You see things totally differently. I don't send out money now to any opportunity that doesn't produce a cash flow. So I've gone away from that accumulation strategy just because, and we'll talk about this again in future episodes, but it's like, all right, you've accumulated $2 million, you're 65, now what? Right. And we mentioned that I think in the first episode, but so yeah, it totally changes your lens, your mindset for sure. And especially for you business owners and real estate investors. I mean, anybody can do this, but especially people that understand the importance of monthly cash flow from various sources. It's super important. And then
I think most business owners would say cash flow is king, because you can have a profitable business, but if you don't have cash flow to keep it afloat, you're not going to have a business too much longer.
That's right. That's what we saw with a bunch of these investment banks in 2008. They ran out of cash.
Yep. Cash on hand. So, well, I think that's good. Do you got any parting shots here, Paul, before we cut this one off? And we'll save a lot of this good stuff that we alluded to for the next episode.
No, I'd say, pick up Nelson's book. If you talk to us, we're going to tell you to get it anyway. So if you plan on reaching out to us eventually, you might as well pick it up now and have read it before you. And all of my clients will tell you that was literally the first requirement I had. They had to read that book, and then we had to talk about it. Right. So that's my parting shot, I guess. Pick up Becoming Your Own Banker by R. Nelson Nash. I actually think they're out of stock right now on Amazon.
Wow.
But I think there's going to be more available soon.
Well, you could always go to infinitebanking.org and order directly from the store. But that's great advice. And in fact, I'd reattack and even add to that, saying, if you want to reach out and talk about moving forward with something like this and you haven't read that book, that we're going to tell you, go read that book and then come back. We're not going to work with somebody who doesn't know why they're doing it. And one of those books is the first step. So do yourself a favor, do your family a favor, get one of those, read it, and then reach out if you have more questions.
No, that's great. And literally folks, that was our journey, right? Dave here was my agent once upon a time, and he sent me that book and one other, and out of the blue with no context, and I read it, and I can tell you, I am glad he did, and I would just wish he had done it back in 2013 when we met. That would have been better, Dave.
Sitting next to each other in Afghanistan, having a lot of other conversations that probably aren't fit to be redistributed to the public, but yeah.
Not to the general public.
Not to the general public, no. Yeah, but yeah, right on. Well, hey, good seeing you, Paul. Looking forward to the next episode. And if you guys want to leave a review, please do. 5-star review. And send us your questions through the email in the show notes, and we'll be happy to answer anything you have.
Sounds good. Great way to end it. I appreciate it, Dave, and I'll see you soon.
All right. Have a great day. See you.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.